What to do when gamma is negative on an overnight swing trade. I know it sounds complex and it is important, but it's basically the pressure around the market. It's not the signal, but it's kind of like a filter around the signal, something that I just kind of ran across, although people who understand this stuff already knew about it, but I figured it out while doing my math, developing my algorithms. And over time, I've realized how much more important it really is. In simple terms, think of positive gamma as the brakes and negative gamma as the accelerator. When gamma is negative, expect the market to be more volatile. When it's positive, the market's much calmer. But what do you do when it turns negative in terms of your overnight swing trade? We are overnight swing traders, and at the end of the trading day, we decide on what our position may be based on our signals. And if we buy, we hold it through the night and we sell the next morning. And there are a number of factors to consider if we're going to go long, go short, buy calls, buy puts. Whatever it may be, quite often is determined based on our signal. Now, we have a free signal on the front page of spytomorrow.com, but we also consider other things, especially gamma. When I first started developing my signals, it was during a time that it seemed like gamma was always negative, and we would often use ratio trades to protect ourselves because of all the volatility. And a ratio trade, especially with options, would be like a 2-to-1 call ratio. So if your signal said up, you might buy 2 calls to 1 put or 3 calls to 1 put. If our signal said down, it would be 3 puts to 1 call. And I have a number of videos on this, but over time, I realized that was great during negative gamma, but not necessarily so during positive gamma. However, as an options trader, we do need volatility, but when volatility is high, we need to protect ourselves. So we do those ratio trades. But when gamma is positive, we tend to shy away from the ratio trades and just go directional and use position size as our form of hedging. But this video is about negative gamma, and it leads to my favorite setup. My favorite setup is when gamma is negative, however, the signal is positive. That means the big money seems to be leaning down. And if the market does go up, they have to catch up, and they're going to push the market up further, which leads to bigger moves. I'm creating this video during a negative gamma market in which the last couple days were perfect examples of how negative gamma works. At the end of the trading day, gamma was negative. However, my signal said up. And the next morning, it went up, and it went up a lot. Now, I did a hedge trade. It was a 2-to-1 hedge trade, meaning I did it in dollar amounts. You can do it in dollars. You can base it off of delta. You can do it based on number of options, like 2 calls to 1 put, things like that. There are a number of ways to approach it. Actually, delta is my favorite way, but the last couple days I've been using dollar amounts. And so I bought 2-to-1 in terms of a call. I was pointing up, but I had a hedge put. And because we were negative gamma, I knew things would accelerate and there would be an opportunity to overcome that hedge. Because the thing is, if you're in a positive gamma and the market doesn't move very much, that negative hedge will just drain on you. But that day, the next morning, it worked out perfectly. And then at the end of that trading day, it was a still negative gamma market. And so I did it again. I leaned up because the signal said up, but this time I used a smaller hedge because I thought, hey, if it goes up more, let's not have a big hedge drain on me. Well, guess what? Because of circumstances, the market did go down, but my hedge went up enough to overcome the call. And even though I was pointing up, the market went down, I still ended up in the positive. Now, obviously, it doesn't always work out that way. Sometimes it's just about minimizing your losses. But that's what this whole thing of overnight swing trading is about. It's about account management, managing your positions, managing your hedges, knowing when to hedge and when not to hedge. And again, maximizing your wins, minimizing your losses is the name of the game. The fact is, when we are in a negative gamma market, our signals will more often be incorrect, just due to the volatility. There's a reason we're in a negative gamma market. People are hedging for the negative, and if things end up being okay, or the expectation gets turned around, or the expected negativity doesn't follow through, well, then the market flies back up. And being prepared for that is important. Unlike a positive gamma market where it's just a little bit up, a little bit down, the moves are just not as great. Again, making hedging just not the best way to go, but it is important to consider your position size. If you're risk adverse, then you may want to stay out of a negative gamma market. So it's good to know that it is exactly that. And usually volatility will give you a hint of that. If volatility is spiking up, well, then we're probably in a negative gamma market. And you can stay out if you wish. But if you want to participate in that negative gamma market and the opportunities around it, well, then consider your position size. Make it a smaller than normal position size, or again, consider other ways in which you can hedge, and that way you can possibly minimize your losses as well as participating in the gains that such a market offers. I generally use options, and there are many ways to hedge with options. However, I generally take the approach that I don't want to risk more than I actually put into the market. I don't want to end up owing more than I put in. If I put in $100, I'm risking $100. I don't want to owe more than that. And so we just buy our calls and puts. And again, you can do it a few different ways. 2-to-1, 3-to-1, 4-to-1 option ratios. In other words, if your signal said up, you could buy 4 calls to 1 put. Or you could buy 2-to-1. Or you could consider delta, and say a 2-to-1 delta would be, say, a 50 delta call and a negative 0.25 put. That would be a 2-to-1 ratio. Or again, you could consider the dollar amount. If you bought a $2 call, you might want to buy a $1 put. Each one of those are valid, and each one has a different risk profile. Personally, I think the delta approach is the strongest because out of all of them, it's the more predictable option. Knowing the difference between positive and negative gamma markets will make you a better overnight swing trader. I'll see you in the next video.